I believe this stock will increase 156% over the course of the next year. And that is just the base case. That is not a bull case or a bear case. That's if everything goes normally. It is a data center stock. You probably have heard of it. It's called Iris Energy, ticker IRON. But I want to talk about the actual fundamentals behind the stock. Let's look at what the company actually owns. Let's look at the realistic price targets that we could hit. And let's talk about the invalidation, what could go wrong. Now, the main thesis here is if you believe that AI CapEx spend is real and it's not stopping, well, then you have to ask yourself, what's the best way to play that thesis? The major limiting factor on all AI training that the CapEx spend is running up against is energy. You can see Elon talk about that here at Davos.
Yeah, I think the limiting factor for AI deployment is fundamentally electrical power.
Right, it's energy.
Yeah. I mean, we're seeing the rate of chip production increase exponentially, but the rate of electricity being brought online is
3%, 4% a year, max.
Yeah, it's clear that we're very soon, maybe even later this year, we'll be producing more chips than we can turn on.
You can also look at countless estimates. This one's from JP Morgan, but there's a million charts just like this showing that the demand for gigawatts of energized power is far outstripping the supply several years into the future. Now, let's just take a step back. Why do you even need this energy if you're an AI company? Well, you need energy to power the huge clusters of chips, GPUs or TPUs or others, that train new AI models. And so far, major unlocks in the quality of AI models have come through two things. Number one is unhobbling, which is a story for another video. But number two is compute scaling, which is just how much raw power and raw GPUs can you throw at training these models so they can run more statistical correlations between the user's question and what a likely answer would be. Recent frontier models continue to prove that compute scaling works. Compute scaling is not broken yet. And so this is one of the key things to watch out for to invalidate the AI thesis. If there is a new AI model that becomes incredibly smart without compute scaling, that's something to be interested in. Now, some people will point to DeepSeek from last year and they'll say, well, DeepSeek saw huge efficiency gains in its training over previous models, so therefore compute scaling will not last. Well, what we saw is, yes, it took a lot less compute to get good results for DeepSeek. However, they just threw more compute on it after that, and then it still got better results. Compute scaling is holding. That's something to keep an eye on, though. And so if that compute scaling holds, then that means if you have energized data centers, if you have access to energy, in the United States, you are sitting on gold. Right now, if you want to go and get energized power in Texas, which is one of the most available energy markets in North America, it can take over 5 years for your request to be approved. And this isn't a thing like you can't just wave a magic wand and have a check fix all your energy problems if you're a hyperscaler, if you're a giant company. They're trying to do that now. Meta, Amazon, Microsoft, they're trying to spin up small nuclear reactors. They're trying to figure out how they can use natural gas in what's called behind the meter, which is instead of accessing grid power, you create your own power. They're trying all these solutions. Some of them will hit in a few years, but in the meantime, billions of dollars are being made. There will probably be an overproduction of energy and an overproduction of data centers as a result of this incredible shortage. The question is, when does that glut come and when does the AI CapEx spend disappear? And I would predict that is 1 to 2 years out, not 1 to 2 months out, as some of the bears seem to say. Now, let's go all the way back to IRON. We understand the big picture. Why is IRON valuable? Well, Iris Energy is one of the few companies that owns the entire stack. They don't just have access to grid-connected power. They own the electrical interconnections, the land, the data centers on that land, the custom racks built for multiple future GPU generations, and the GPUs themselves. Now, sometimes this has led to the market discounting them because this is very asset heavy. CoreWeave is a company that's similar. However, CoreWeave doesn't own every layer of their stack. They rent certain parts of it out and work with different contractors. I would argue, and many of the IRON bulls would argue, that being asset heavy is a feature, not a bug. The advantage of owning every layer of the stack and being vertically integrated is you can optimize each layer, not just for efficiency and cost, but also for reliability, which is very important to hyperscalers renting your infrastructure. If you look at CoreWeave, they had a problem last November where their data center supplier, Cores, missed deadline and it caused some delays and it caused the stock to drop. IRON has had no problems like that yet because they control every element of the stack and so they can plan their future infrastructure very well. And the reason they can plan their future infrastructure very well is the founders, Dan and Will Roberts, come from the infrastructure background. They started one of the largest infrastructure investment funds in Australia, which oversaw huge amounts of energy infrastructure. They then went on to found Iris Energy when they saw that digital technologies were ramping up exponentially, like Bitcoin, like AI, but the physical infrastructure needed to power those technologies was not ramping up exponentially, and in fact it can't, at least not yet. And so if you control the physical choke points that power the exponential digital curves, you are sitting on gold mines. And so they founded a data center company which began, they say it bootstrapped themselves by doing Bitcoin mining in those data centers. And they went on to dominate the Bitcoin mining market. One of the best Iron analysts is this account here, Agrippa Investments, and he pointed out that Iron went on to become the only Bitcoin miner to achieve multiple consecutive quarters of operating profitability during one of the worst bear markets for the mining sector in history. And you can see here the graph of their operating profitability over time. So this is the benefit of vertical integration. Iron owns the entire stack, does nearly everything in-house, and that allows them to plan for the future with precision, setting them apart from many competitors, as we talked about earlier, who are plagued by delays. Okay, so Iron has a great management team and they sit on very valuable assets, but what's the margin of safety here? Well, even if the AI boom came to a halt or slow down, the data centers Iron owns will still be valuable and they can be converted back to Bitcoin mining if needed. Iron currently has close to 3 gigawatts of powered land capacity. If you look at how much data centers cost to build, it's about 10 million per megawatt, which means that if they manage to build out all their data centers, including Sweetwater, which should be nearly finished in April and then fully finished in late 2027, then Iron will be around a 30 billion market cap as a bear case. That's just the pure value of the data centers they own based on how much it costs to build them. I think that's a pretty good floor, considering Iron's market cap is far below 30 billion right now, even after it's gone up. So let's talk about the base case. What if they can monetize their energized gigawatts with AI cloud and co-location deals? Well, then the targets get much larger. Currently, Iron themselves projects $1 billion in revenue for 2026. And if we were to take a 30 times expected value to EBITDA multiple, which is similar to other companies in the space like Applied Digital, then at their current EBITDA margins of 40%, Iron's enterprise value would be around $41 billion, which is not too shabby at a current market cap of 16 billion. That's if they hit their target. Well, what if they sell out all of their energized capacity? And it could take longer than 2026 because Sweetwater is not going to be finished until late 27, but let's just say they do over the course of the next few years. Assuming $1 million in profit from each secured megawatt, which is standard, then if all the current capacity is sold out, they should be making $1 billion in annual revenue. And if you apply their current margin to that and a 30x multiple, you get an enterprise value of 51 billion. And this is the base case for a few years from now. This is not assuming that they secure any more power. This is assuming their pipeline of future sites is at 0. This is assuming they don't increase their margins. And in a true AI bubble, there's no reason 30x couldn't grow to 50x or 60x and Iron could not pass $100 billion in market cap. There's no reason why not. But let's take a step back. We should watch out for several invalidations of this thesis. Will Iron successfully deliver on their contract with Microsoft, which they signed last November? If they fail to deliver on this contract, it's going to be very hard to sell future deals. All signs point towards them delivering on this, but it's something to keep an eye on. Will they continue to monetize their available gigawatts effectively through more hyperscaler deals, preferably diversified? We don't want to sign a bunch of deals with just Microsoft. We want deals with Google. We want deals with Amazon, and ideally not OpenAI because the market is a little skittish about them right now. How long will it take for Iron to sign those deals? I would like to see them start to be signed quite soon. There's a lot of available energy for Iron to make deals with, and this shortage will not last forever. It might last for another year. I would prefer the company to steadily sign new deals every few months than trying to hold out for the best possible price a year from now when you don't know what could happen. Another question is how future-proofed are Iron's data centers as the next few generations of GPUs come out? So every year, every few years, NVIDIA will release a new generation of their flagship GPUs, and they tend to be much more efficient but much more power hungry than the last. And so right now, Iron is currently running their data centers slightly under the peak of what they could be getting from the GPUs that they have. And our understanding is they're doing that because the racks are set up to be future-proofed for future generations of GPUs, and so they're not perfectly efficient with the current generation. It's important to keep an eye on that, if that's true as this develops, or does IRA need to do a bunch of maintenance and retrofitting every time there's a new GPU generation? Another key question in the entire AI sector, not just for this company, is how valuable are the current generation of GPUs next year, 3 years from now, 5 years from now? Because if you look at someone like Michael Burry, he would say that after 4 years, the GPUs are far less valuable than everyone is claiming they are. A key counterpoint to Burry's claim is the rental chart of NVIDIA H100s, which has been steadily climbing in recent months. H100s are a 4-year-old GPU. If you listen to the AI bears, they should be worthless, and yet the price to rent them is increasing right now. So that's a narrative violation for the bears. And then how much power does Iron have in the pipeline beyond their disclosed gigawatts? That will give us more vision into the ceiling of the company. So in summary, the bear case is that the data centers they build are valuable and they finish building them. That's a $30 billion market cap. The base case is they sell out their power pipeline with high margin AI cloud deals. That brings us to a $51 billion market cap. And the bull case is they dominate the data center business and become a hyperscaler in their own right, which could fly past $100 billion.